Hello, boss. The numbers are in, and the project was a real big success. I put in a lot of work on that, and I streamlined our processes and made everything more efficient, increasing our bottom line. I think that with my devotion to the workplace and the team, that we could talk about a small pay raise. Who are you and how did you get into my office? Security! One of the great things about being a dividend growth investor is that you don't have to have these awkward conversations with your boss to get a pay raise. These pay raises kind of come automatically and you don't really have to do anything to get them. You don't even really have to do anything to get the income in the first place with being a dividend investor. All you got to do is get the money to buy the shares. Once you own the shares, you're going to get about 4 paychecks a year. Then with a dividend growth company, you're kind of expected to get a little dividend raise every year. And this can be anywhere from like 2% to 20% depending on the yield. I would say that technically a dividend raise of less than 1%, it still is technically a dividend raise, but I wouldn't say it really counts. With dividend investing, or dividend growth investing, there's an inverse relationship with the yield and how much the company will raise that dividend every year. If you have a company with a high yield of something like 5%, then you can expect a smaller dividend raise once a year. But if you have a company with a lower yield of like 1.5%, then they tend to increase their dividend much more, like 15 or 20%. If you're reinvesting your dividends and say the yield is 2%, then you get a 10% dividend raise, then next year your dividends will actually grow by 12%. And if you keep this up after 6 years, that dividend income will double. And then another 6 years after that, it'll double again. So I think that dividend growth investing is one of the best ways to achieve your financial goals, whether it's like early retirement, regular retirement, or passive income. In July, we had 3 companies that increased their dividends. And these companies have a history of paying dividends, and they're known for being solid, reputable companies. First company on our list is National Retail Properties, ticker NNN. This is a real estate investment trust, and it holds freestanding retail buildings. Not malls or strip malls or apartment buildings or anything like that. These are buildings that are one building, one tenant, much like realty income, and it's also triple net lease. And that just means that the tenant's responsible for paying the property taxes, the maintenance, and the insurance. They have about 1,161 buildings and 370 tenants, much like realty income and like the same kind of tenants. Some of their top tenants include Circle K, 7-Eleven, Taco Bell, Wendy's, and KFC. In the last quarterly earnings, it reported a 98% occupancy rate, and then it received 97% of the rent due. Right now has a yield of 4.3%, and it did only increase the dividend a small 2%, but it's a REIT and they kind of do it like that. They have smaller dividend increases. On average, it's returned 13% a year for the past 20 years. And it has a good payout ratio of 68% from funds, available funds from operations. And this is a better metric to use in your traditional net income, dividends paid out of net income, because it's a REIT in a different corporate structure. Second company on our list is Walgreens, ticker WBA, the pharmacy company. And to be fair, Walgreens has had a rough 6 years when it comes to share price. It got to a high of $96 6 years ago, and now it's trading at $46. And has faced some stiff competition from online discount pharmacies. And now we have the news and the rumors about Amazon wanting to join the pharmacy space to compete with the likes of Walgreens and CVS. has a decent yield of 4.15%, and that's a good yield, and its dividend increase was 2%. Dividend safe. It does have a low payout ratio of 39%, and there is room for them to keep raising that. Traditionally, it's had a lower yield than this, so it may be a good time to buy. It usually has a yield of less than 3%, but when you see a company like this have a big spike in its yield, that could be a bad sign. They had a rough 2020 on the income statement due to COVID, but they think that's over, and the company's opening up again, and they expect to get some revenue growth going forward. They did have a little hiccup on their last earnings report because there's fears that all the COVID vaccine money is going to dry up for everybody getting their vaccines and stuff at Walgreens. So the income statement isn't great. The cash flow statement looks a little better. Balance sheet isn't great either. They have about $6 billion in cash and short-term receivables versus $34 billion in current liabilities. But they did sell off some part of their company, help make their balance sheet look a little better. So if you already own Walgreens, it may be a good idea to keep an eye on it. And if you don't own Walgreens, maybe you want that 4% yield. And maybe, though, you should make sure that you haven't looked elsewhere for 4% yield that could be much safer than Walgreens. Next company on our list is Duke Energy. This is a utility. Utilities are boring companies. They produce energy and sell it to the consumer and then pay that money out to dividends. People invest in utilities because they're safe and they're almost like a bond replacement. They don't have too much price appreciation and they pay a healthy yield. Duke's yield is 3.8% and they raised it 2%. Duke has a payout ratio of 75%, and this is in line with the space, with something like Southern Company having a payout ratio of 79% and then Con Ed having a payout ratio of 72%. It does seem a little expensive on the yield side since it's usually yields over 4%. And they've been kind of arguing with Elliott Management, an investment hedge fund firm. And Elliott Management wants to break up Duke Energy into 3 smaller companies. And they think they're going to be able to increase the market cap of the 3 companies separately by around 20%. And make one of these companies a buyout target for a larger utility. So far, Duke Energy does not think that's a good idea, and they don't plan on going along with that at all. It's returned on average dividends reinvested of about 10.8% a year for the past 10 years. And trades about $103 right now. They expect to grow revenue about 5 to 7% over the next 4 years. Regarding renewable energy, they're planning on shutting down 50 to 70% of their coal power plants by 2030 and then triple the amount of renewable energies they're producing. I think dividend growth investing is one of the best ways to grow your wealth and achieve your financial goals. You get these streams of income that are visible and you can spend, and then you see these dividends increase every year so you feel progress. And then it motivates you to buy more shares. And it's going to take you a lot closer to your financial goals than something like meme stocks. Go ahead and leave a comment down below if you own any of these 3 companies. Like this video if you learn anything. Subscribe to the channel if you haven't. Then I want you to go have a good day. Alright? Justin out.